Welcome to the Deep Dive. Today, we're jumping right into the financial results and the strategic story coming out of AKA Brands Holding Corp.
AKA.
Exactly, AKA. Their latest quarterly earnings call was, well, it was a real mixed bag.
It really was. And you have to remember, the whole retail sector has been under so much pressure.
Especially discretionary apparel.
Exactly. So for AKA, it wasn't enough to just post decent numbers. They really had to sell a compelling story about where they're headed.
Okay, so let's get right to the punchline for Q3 2025. This was pretty clearly a quarter that missed what analysts were expecting.
Oh, a definite miss, both on the top and bottom lines.
But, and this is the interesting part, management spent the whole call pointing to these underlying structural improvements that they believe, make the future a lot less risky.
And that's the tension we need to unpack. So let's just lay out the numbers. Revenue came in at about $147 million.
Which was down almost 2% year over year.
And more importantly, about 4.2% below what the street was looking for. EPS was also a miss, negative 46 cents versus a negative 44-cent consensus.
Right, and adjusted EBITDA was down too, from about $8 million last year to $7 million this quarter.
So if you just read those headlines, you'd think the stock would have gotten hammered.
But it didn't, not really. Which brings us to the good news. Despite the sales pressure, gross margin was up.
Up significantly. 110 basis points, which is huge. It hit 59.1%.
And I think this might be the most important number for investors worried about stability. Their operating cash flow.
A massive swing.
Huge. A $21 million improvement year to date. They went from burning $6 million last year to generating almost $15 million in positive cash flow this year.
And that's really what stopped the bleeding in the stock price. I mean, it dipped a little in after-hours trading, for sure. But it found its footing really quickly. It's like you could see investors doing the math in real time, weighing that sales miss against, real progress on efficiency and cash.
So that's the perfect setup for our first deep dive. What was the real operational problem that caused the sales miss, and how on earth did they grow margins while sales were actually falling?
Management was very clear on this. They put the blame squarely on temporary execution issues.
Specifically?
Inventory shortages and a lack of, quote, fashion newness for their best sellers in the U.S. Basically, the hot items sold out way faster than their supply chain could restock them.
But what's so fascinating is that it doesn't seem like it was a demand problem.
Not at all.
Their active customers actually grew a little bit to just over 4 million, and total orders were up more than 2%. So people were showing up they wanted to buy.
They wanted to buy, but the shelves were bare. And that flows directly into the next metric, which is average order value, or AOV.
Yeah.
It dropped almost 4% to $78. And that is the canary in the coal mine for fast fashion. It tells you customers came, they bought something, but they couldn't find those key higher-priced items to really fill up their cart.
Okay, so if sales were down because they were out of stock, how did they pull off that 59.1% gross margin? That's the part that feels counterintuitive.
It was a combination of three things. First, and this is the most important one structurally, is the success of their Princess Polly physical stores.
Which have better margins than online.
Much better. So as those stores become a bigger piece of the pie, the company's overall margin naturally rises.
Okay, that makes sense. What's number two?
Second was just a natural outcome of the inventory problem. If you have fewer items to sell, you don't need to run as many promotions or discounts.
Ah, so less discounting helped the margin.
Exactly. And the third piece was a bit more technical, something they called a duty drawback benefit.
Okay, you have to explain that. What is a duty drawback, and why did it help them so much this quarter?
Sure. So it's basically a refund on import taxes. If a company like AKA imports goods into, say, the U.S. and pays a tariff, but then re-exports some of those goods to sell in another market like Australia,
they can claim back the initial U.S. tariff.
You got it.
Yeah.
And getting that refund check this quarter give their gross profit a nice timely boost. It helped juice that 110 basis point number.
So it's a mix of sustainable strategy, the stores, and some more, let's say, situational wins.
I think that's the right way to look at it. And it shows up in the geography, too. U.S. sales were down 3.6%. That's where the inventory problem was worst.
But Australia and New Zealand?
Strong, up over 5%. It just shows that when the product is there, the demand is absolutely solid.
Let's talk about that supply chain. Management's argument is that these disruptions were a temporary side effect of a good thing, diversifying their sourcing.
Right, and that's a huge strategic shift. For years, fast fashion was all about concentrating sourcing in one place for maximum efficiency.
And now it's about resilience.
It's all about resilience, moving production to different countries, Vietnam, Central America, wherever. It protects you from, geopolitical risk or a problem at one factory. But in the short term, it's messy. It creates friction. And that friction is what caused the out of stocks in Q3.
Okay, that's a really critical piece of context. Yeah. Let's pivot to the big structural wins the CEO was so focused on. Top of the list has to be the debt.
Without a doubt. The single biggest piece of good news was the successful refinancing of their credit facility. They pushed the maturity date out to 2028.
Which is huge for a retailer.
It's a game changer. It's an $85 million term loan, plus about $35 million in a revolver. When your debt is coming due soon, every little quarterly miss feels like a crisis.
Because you're worried about default risk.
Exactly. Pushing that wall of worry out to 2028 just gives them so much breathing room to focus on running the business, not just managing the balance sheet.
And a big part of running the business is that physical store expansion for Princess Polly. They opened their 11th and 12th stores this quarter.
And they are killing it. The company said the stores are beating all their expectations on revenue, profit, and new customer acquisition. They're not just stores. They're becoming these high-margin marketing hubs.
With plans for another 8 to 10 next year.
Right. It's a core part of the growth story now.
Okay, now for what I thought was the most interesting forward-looking nugget from the whole call. Princess Polly is piloting instant checkout on ChatGPT.
Yes, in partnership with Shopify. This is not a gimmick.
It sounds like a pretty big deal.
It's a massive deal. I think it's maybe the most undervalued part of their story right now. Think about it. You're removing all the friction between seeing something you like and buying it.
So you could be talking to an AI, ask for a dress, and just buy it right there in the chat.
Instantly. No clicking to a website, no new tabs, no checkout pages. You go from discovery to purchase in one place. For the impulse-driven fast fashion customer, that is incredibly powerful.
It's kind of the holy grail of social commerce, right?
Yeah.
Capturing the sale at the exact moment of intent.
Precisely. It's a test case for where this is all going.
As exciting as that is, we have to come back to reality. The Q3 miss forced them to cut their full-year guidance.
They had to. The hole they dug in Q3 was just too big to climb out of in one quarter.
So what's the new forecast look like?
They brought full-year sales guidance down to around $600 million, from about $610 million before. And adjusted EBITDA was cut too, down to about $23 million. It just confirms that fixing the supply chain is costing them more than they hoped.
But they sounded pretty confident about Q4.
They did. They said inventory levels are now normalized, so they're fully stocked for the holidays. And so far, quarter-to-date sales are tracking up low single digits.
Which is what they need to hit those new targets.
Right, and they raised their capital spending budget a bit to pay for all those new stores they're building.
So if you put this all in context, the retail sector is weak, aka stock has been beaten down about 33% for the year before this call.
And it creates this incredibly polarized view on Wall Street. On one side, you have the analyst consensus, a strong buy rating with a price target of over $25.
Which is like 100% upside from here.
It's huge. They're clearly focused on the margin story and the de-risk balance sheet.
But on the other side,
you have data models, like the one from TipRanks, that look at the numbers and just tag the stock as neutral. The AI sees the revenue pressure, it sees the leverage, and it's just more cautious.
So it all comes down to the holiday quarter.
100%. They have to prove the inventory problems are truly gone and that this new omni-channel strategy can actually deliver consistent growth again.
All right, let's pivot to our favorite part of the deep dive. This is not financial advice segment where we sketch out a high risk but plausible trade idea.
Okay. So for AKA, the entire trade thesis hinges on believing the market has got it wrong, that it's overpunishing them for temporary operational noise.
And undervaluing the structural fixes.
Exactly. The debt refinancing to 2028 is the foundation. It takes away the near-term bankruptcy fear. And the gross margin expansion proves the business model pivot to stores is working. You have to believe Q3 was a blip, not a trend.
So, given all that, what's the actual trade?
It's an aggressive one. You go long the stock, treating it as a high volatility, event-driven play.
The event being the next earnings report.
Precisely. The goal is to capture a 50% retracement of the stock's big 12-month slide. You're aiming for a price somewhere between $18 and $20 a share.
And the catalyst is just them delivering on what they promised for Q4.
That's it. If they report that low single-digit sales growth and show the margins are holding up now that inventory is fixed, the stock could re-rate very, very quickly. It's basically a bet that the strong buy analysts are right and fear has created a mispricing.
A high-risk bet on holiday execution. I like it.
It's definitely not for the faint of heart.
Okay, so let's zoom back out and wrap this up. For AKA brands, Q3 was painful, driven by those temporary supply chain headaches.
But underneath that, they locked in some huge structural wins. Better margins, way better cash flow, and most importantly, they pushed out their debt.
So the final question is?
The final question for AKA isn't really about whether they can manage costs anymore. I think they've proven they could do that. The real question is whether all these cool, innovative digital efforts, the AI tools that Princess Polly ChatGPT checkout, can deliver the must-have new fashion fast enough to really capitalize on it. Yeah. They have to nail the merchandise execution to make the whole strategy work, especially as they keep opening more and more physical stores. That's the key to the whole thing.